Welcome to CFTC Talks. I'm your host, Andy Bush, Chief Market Intelligence Officer for the CFTC. Hey, just a quick reminder, there's an important disclaimer at the end of the show that's important for you to listen to. You know, from the US to China to places like Swaziland and Gibraltar, a quick thank you to all of the 100 countries that have downloaded the podcast and over 50,000 people that have listened to it. We greatly appreciate it. You know, one more thing, just so you know, you can send us suggestions for shows via email. You can use podcasts, podcasts, at cftc.gov. Now, you can already leave comments on many of the outlets the show appears on, but we thought we'd make it easier for you to connect with the show. So if you have time, drop us an idea or comment or suggestion for guests. Now, listeners know that in my role as Chief Market Intelligence Officer, I research a wide range of market structure issues and new financial technologies. I mean, this helps the agency better understand policy-related issues for commodity markets and all the markets we regulate. Now, sometimes we take a look at AI, sometimes it's virtual currencies, and sometimes it's utilizing technology to provide firms the piping or the plumbing for their financial services and trading platforms. Now, these types of companies have knowledge of core financial and quantitative development that gives insights into how the markets are functioning and their structure. Today, we're going to speak with one of those people involved with that. For today's show, we welcome Dr. Mark Higgins, Chief Operating Officer and co-founder of Beacon Platform, Inc. Now, from their website, Beacon Platform, Inc. is a financial technology company that delivers cloud-based end-to-end development and production platform. Their clients leverage Beacon trading, analytics, and risk management applications and transform the use of their technology through Beacon's platform. In other words, they help quant and developer teams in the financial services industry to scale. They provide a cloud-based platform that gives those teams a unified environment that contains all the technology and analytics tools they need to solve problems for their businesses in a collaborative, extensible way, avoiding the common trap of constructing many isolated stacks that don't interact cleanly and are hard and expensive to maintain. So with all of that, Mark, welcome to CFTC Talks.
Thanks.
Hey, I'm excited to have you on to cover a wide range of financial technology issues. But first, I do want to take a step back in time and talk about your background. Ladies and gentlemen, Dr. Higgins has a BS in engineering and a PhD in theoretical astrophysics from Queen's University in Kingston, Ontario. So in fact, Mark, you are a rocket scientist.
I wish, theoretical physicists have the luxury of just modeling things without worrying about implementation. Rocket scientists have to worry about actually building things and making sure they don't blow up. And that way my career of post-physics is a lot more like rocket science in some ways.
That's great. Well, seriously, you've had a really interesting background in market strategy and quantitative research while working at both JP Morgan and Goldman Sachs. But honestly, what jumped out to me was the beginning of your career when you worked at an energy firm designing a trading and risk management system for the electricity and natural gas derivatives markets. So I guess the question is, how did you go from getting a PhD as a quote unquote rocket scientist to getting into some of the commodity markets we here at the CFTC regulate?
Yeah, and it's interesting. I think Wall Street figured out kind of in the early 90s that physicists and engineers had a lot of the kind of math and coding skills that they were looking for with the growing derivatives markets. And so quantitative finance in general was starting to pop up on the radar of grad students like me. I got that job on the power and gas trading desk because the power markets deregulated in 1996. And utilities like the one I was working at were starting to build out trading desks. And those trading desks realized they needed the same kinds of trading and risk systems like the ones used in more traditional financial markets, at banks. And so that's why they were looking for people like me.
Oh, that's interesting. Well, what did you take away from that first experience when you were working there? It must have been a little bit of Alice in Wonderland, because here you go from doing something quite unique in the astrophysics space to going onto a trading desk. Yeah,
I mean, it was it was really neat. I kind of got dumped into the deep end with that job. There weren't any other quants around, so I kind of had to figure out on my own how to solve all the pricing and risk problems that cropped up on the desk when I was there. I was pretty naive looking back on it, and I completely missed some pretty well-known solutions. But it was an amazing way to get introduced to the field, really close to the traders and the business and stuff like that. And that was true for kind of the finance side, but it was also the same thing for coding, for programming. It was there that I learned, unfortunately the hard way a few times, that the most important part of programming in a real organization is making it easy for other programmers to understand your code.
That is a great lesson to learn, and I think it's so salient to today. I have to laugh because I'm thinking of my experience. I was a currency trader for a long time, but that really helped me sitting on a trading desk, watching it evolve in real time and making calls on the market, watching it blow up on me, making bad calls and learning from that. So I can imagine it was a fun experience from that standpoint for you. But let me say, as you've been deeply involved in quantitative analysis and algorithmic trading, walk our audience through the evolution of how the digitization of the financial markets occurred and how this changed the structure of the markets. You alluded to it in the 1990s.
Yeah, I mean, after 2 years working at that utility, I moved into the foreign exchange business at Goldman Sachs. And that was like a really fascinating place and time to watch the evolution of markets. But, like you were talking about, spot FX trading in particular went from mostly voice trading in the late 90s to like mostly electronic trading over the span of 10, 15 years. And I was kind of just sitting there in the market as that was happening. I was focused more on kind of the options businesses, but it was ended up getting closer to the spot business over time. The job of a market making trader in spot FX used to be, two main things. They make prices on individual deals as clients called up, and then every deal that they do with a client, they take the other side of that risk position. And so they had to manage the risks of the portfolio that resulted from all those client deals. And that was kind of like their second job. With the move to electronic trading, both those jobs are almost entirely performed by computer programs now. And the job of those like few remaining traders has changed to one where instead of managing each deal, they kind of sit at the controls of that machine and make sure that it behaves. And that was, a titanic shift in everything to do with those markets. Over 10 or 15 years, bid-ask spreads compressed by like a factor of 10 due to greater price transparency because of the electronic distribution of all those prices. And at the same time, volumes increased by about a factor of 10. That price transparency and efficiency in those markets meant that competition for client business became really, really aggressive. So aggressive that, the bid-ask spreads that dealers will show clients are now tighter than what they can get trading with other dealers in the interdealer market, which is kind of the real market. Mm-hmm. It used to be the other way around, right? So in the old days, you could, buy from a client at your bid and then sell that position back out into the interdealer market and make money on that because you show a wider spread to the client than you'd see in the interdealer market. And so your risk management was pretty easy. You could basically back-to-back every trade and still make some money. That's not true anymore. So what that means is they need to be a lot more quantitative about how they approach risk management. For example, they might hold risk when a client trades with them and hope that another client comes in and trades the other way and nets the deal out where they get paid the spread on both legs, which means on average then they occasionally, if they build up a big risk position, they have to go and trade in the interdealer market. But what that means is on average they pay less by way of spreads to other dealers, but hold the risk position longer. And then they have to think about how to do that efficiently. And that's kind of a tricky quantitative problem. From the perspective of people like me, for like quants and technologists, right, it's been a really interesting change. Like the FX spot traders, when I first joined Goldman in '98, like they didn't really care about them at all. They didn't really use technology. It was very much a pretty technology light business. Certainly not very quantitative at all.
No, I remember because I was a spot trader back then. And it was interesting because back in the 90s, that's when you had EBS come on, which is electronic broker system, I think it was, and Reuters matching developed at that time. And I was at a smaller bank. And what I loved about it was it leveled the playing field versus the voice brokers who always seemed to benefit the higher volume trading clients that were out there versus me, this little guy in the Midwest. So I love those machines. And it's fascinating to hear you kind of walk through this and see that was the genesis, the development of the quantitative research and trading that's evolved to today.
Absolutely. And like now those businesses are all about technology and, analytics and things like that. They can't run without them.
Right.
I think one of the like interesting signs of the times is a colleague of mine who is a quant developer at Goldman from the early days, who helped build out kind of the electronic trading stuff at Goldman and a few other places, is now running the electronic trading business, like on the trading side for like the macro businesses, rates, FX, and commodities, the big bank. So he's not running the technology team or the quant team, but he's actually running the business.
Oh my gosh.
And that kind of shift isn't rare these days. Like the whole structure of that business has changed. The whole way that you run the business has changed, and that happened in Spot FX, and that's happened or is happening in lots of other markets as well.
Well, I guess that brings up the point that this is the role, the changing role or the changed role of quants or quantitative trading in the capital markets over the last 15 years, and I guess it's kind of. To be a trader now and in the future, I guess my question to you, Mark, is like everybody has to have these skill sets, right?
Yeah, like it's in terms of like the evolution of quant roles, it's been pretty dramatic. Like, and I'm talking mostly about like sell side quant roles now, since that's what I'm most familiar with. But like when I first started, quants were basically like exotic derivatives quants. So they'd, work with structurers on how to price and hedge customized derivative trades with corporates and real money clients like pension funds and stuff like that. And then we work with traders on figuring out how to recycle the risk on those complicated trades to other investors like hedge funds. And then spent a lot of time thinking about how to run all the complicated models for pricing and risk management fast enough that the traders could manage their risk while still kind of maintaining the accuracy you need to be profitable. So those are the kind of problems that we traded or that we worked on. Mm-hmm. But as these flow markets like the spot FX market, the kind of high volume simple product markets, as those moved electronic, quant started to get pulled in there, and the skills you need in that are a little bit different. The derivatives quant, the sort of mathematical tools that you use are pretty similar to stuff in like undergrad physics, like heat transfer and quantum mechanics and things like that. And so that was why the sort of physics community got pulled into quantitative finance back then. The skills now for this sort of electronic trading stuff are much more like the kind of traditional buy-side quant skill set, more like statistics and data science and machine learning and stuff like that.
Okay.
When I was running the quant group at JP, we called those kind of quants algo quants as opposed to the kind of traditional derivatives quants. And to be honest, like, especially since the credit crisis, those algo quants are the ones who are doing all the kind of fun stuff now. The derivatives quants are still there, but they got funneled into loads of like regulatory risk calculations, like capital reserve and complicated counterparty credit risk and FRTB and all that kind of stuff. Which were some interesting problems, especially like really complicated calculation problems, and use a lot of really, Greek computing and all that kind of stuff. But it wasn't working that close to the trading desk. A lot of it was pretty far from the trading desk. So the algo quants are the ones who are doing most of the kind of direct front office stuff.
Yeah, to me, taking a step back, this is the fascinating aspect of where the financial markets are today. And I was speaking with our Chief Innovation Officer, Daniel Gorfine, about Fintech and where it's heading. And we both kind of laughed and came to the conclusion that finance is Fintech and fintech is finance. Basically, because of the digitization of financial data, we're all in fintech. And I guess the question is for you is how is the financial industry adapting to this rapid technological change? I mean, you worked at some very sophisticated companies. Has that permeated out throughout the entire industry?
Yeah, though I disagree a little bit with the premise. Like banks in particular talk a lot these days about how they're really technology companies.
Right.
But really, they're not technology companies. They're financial services companies who have clients who are happy to pay them money to receive financial services, and technology is just like a tool that the banks use to service their clients, really, right?
No, great point. Great point.
My co-founder, Kirat Singh, he often notes that like a big bank might have 10,000 developers servicing like a few thousand users, like traders and salespeople and stuff. Whereas Google has 10,000 developers serving billions of users, and like that's a tech company. You know what I mean?
Right. But, yeah. Scale.
That said, like financial services companies definitely need a lot more technology to service their clients than they used to 15 or 20 years ago. And I think the fortunate thing for them is that it's happening at a time when a lot of real enterprise technology is becoming commoditized. Like, think about cloud computing as an example. Mm-hmm. With like old style, like on-premise data centers, on-premise infrastructure, that's where like I own the computers and they get installed into a fixed data center. If I needed like another 1,000 processors to run some big complicated, it's a real hassle to get them. Like, I have to pay upfront capital costs to buy the computers, and that means I have to get like budget approved to do that. And then I have to wait 3 or 4 months until those computers get delivered into the data center, and then wait like another month or two while some team of like human beings manually configures the computers in the way I need and gets them all set up. So it takes like 6 or 9 months to get new computers in the old model. But with the cloud, I can rent compute just when I need it, rather than like paying for it outright. Mm-hmm. And I can get it like instead of 6 or 9 months, I can get it in like 2 minutes.
Right.
So it's like that's the kind of tool that's available to banks now. I don't want to like minimize how complicated it is to make that transition from like on-premise infrastructure to cloud infrastructure, but all the tools to do it exist now. And most financial services companies, even like the biggest and slowest and most bureaucratic of them, are, when it comes to cloud stuff as an example, they're working pretty hard to figure out how to make that happen.
Yeah, it's this is great because obviously in what we do at the CFTC and what I do, we do look at how technology impacts the markets and how the commodity markets, whether it's soybeans or corn or interest rates in the futures markets and derivatives markets or risk transfer markets, get impacted by this. So this is a great discussion because our markets are obviously being dramatically changed by the new technology. And maybe if you could just take a moment to talk about, I hate to always bring this up, but let's talk about AI for just a little bit and how that's being utilized from your vantage point, what you've seen change over let's say the last 5 years instead of 10, just because it's rapidly evolving. And I've probably seen about 10 different presentations on this just since I joined the agency about a year ago. I'm sure you've seen many more than I have, but I'm really curious as to what your opinion is, how this plays a role in the markets.
Yeah, I mean, I think all those kind of buzzwordy things, AI, machine learning, data science. I think they really have a lot of potential, and people have been trying for a while to figure out how to actually use them. So far in the front office, especially, it's really actually not had that big an impact so far. I remember maybe it was like 8 years ago or so when I was at a bank, we were asked to figure out, let's figure out some use for like predictive analytics, machine learning in the front office, and we all had to go out to our businesses and try and poke around and come up with some ideas. And We didn't come back with anything good after, looking at it for a while. Like the best we came up with was something like a recommender engine for derivatives trading, like the sort of an Amazon recommender thing. Like clients like you who bought a dollar yen volatility swap have also bought US dollar swap options or something. And
was there any comments below? Like they have like reviews. How did this trade work out? This is
4 stars.
Right. 4 stars, 5 stars. I got a big bonus. I'm sorry. Go ahead.
Yeah, but I think the problem, I think that's kind of symptomatic of the problem applying these techniques, because the first sort of top tier set of results you get out of an analysis like that one is kind of trivial and obvious to everyone who's involved. Like that's just like a client who's a global macro vol trader, and the salesperson who covers them already knows that, and it's not a surprise.
Yeah. And
then kind of the second tier of things that you get out of it are so minor and fiddly that they don't ever add any value. So it was really hard to figure out how to use that the right way. That's what I think now, you're mentioning, in the last 5 years versus the last 10 years, I think there are some interesting places that it's coming up. One that I know has seen some real production use is looking at trading patterns and looking for, evidence of fraudulent trading patterns automatically. That's one that's plugged in the front office in a bunch of places now. There's also, one that we've been looking at. There's a new technique called deep hedging that the Quant team at JP Morgan came up with. And basically it uses neural networks to figure out how to most effectively hedge derivatives in illiquid markets where there's lots of transaction costs and infrequent hedging and stuff like that,
right.
In a way that's more efficient than kind of the traditional Black-Scholes-ish, pricing stuff. So, at Beacon, we're doing a bunch of research to see whether that can help our clients do stuff like more efficiently hedge, complex physical commodity assets like power plants and storage facilities and things like that.
Well, you brought up Beacon, and I want to talk about that because you co-founded this company with Kretzing in 2014 after spending 20 years on trading floors as a quant developer, a trader, a manager, and developing trading and risk management software. So as you look out into the fintech space, what was the need that you saw that was going unfilled that you guys decided to go after?
I think for us, our careers, working in big enterprises building technology, one of the things that we recognize, and I think a lot of people do, is that developing enterprise software is really complicated. Doing stuff like efficiently using and sharing data and collaborating effectively on development and sharing code and accessing large-scale compute and deploying changes into production in a controlled way that's not overly bureaucratic. It's just hard to do all that stuff. And if you look at people like sort of analytic developers like quants or technologists who work on trading desks, they typically don't know how to do any of that stuff. They're good at solving business problems with technology and analytics that come up, kind of day to day, and they're really good at that. They just, it's, the enterprise technology thing is just a different skill set, and that disconnect means that, quants, for example, aren't allowed to touch the production environment, which is super frustrating for them and really inefficient. Either they do that or they actually do build production code, and then it becomes quickly kind of unstable and hard to maintain. So that's kind of the problem that we saw, is that, there's all these really smart analytic developers who are really commercial, and they kind of have their hands tied when it comes to actually developing production code. And that's kind of what I think we bring to the table. We spent a long time working at a bunch of different banks, figuring out exactly what kind of tools does that kind of developer need to avoid falling into the trap of either not being able to touch production and getting frustrated, or building stuff that isn't scalable. And that's kind of our main product at Beacon. It's a platform that contains all the kind of enterprise technology tools that those people need, and lets those commercial developers focus on solving problems for their business without worrying that they're kind of painting themselves in a corner 3 or 5 years in the future.
Yeah, and I think also, too, you run the risk of having all these different silos within a trading floor, for instance, of everybody developing their own code and none of it being able to communicate with each other, but also the inability to go to somebody else's and look at this and say, well, look, I solved this problem. Maybe somebody else on the floor has tried to do it too. Maybe I can share that, but because the code's so different or the structure's so different, it won't work. And you really have a lot of inefficiency. It seems like that's what you guys have overcome as well.
Exactly. Like I think like everyone kind of recognizes the value of doing the stuff that you're talking about, but actually executing it in a way that works in kind of modern enterprises is really tricky. And I think that's what we ended up figuring out how to do pretty well.
Well, what would you say when you talk to these guys, and you kind of ran through it, but I just have to ask the question to be super clear. What are the biggest challenges for your clients? Is it that they are, they're really into trading and then they have a disconnect? They have a do not touch sign on the enterprise software component, and that's really what's their biggest challenge, or are there other additional items?
No, I think that whenever I meet a new client, or a prospective client, I talk about this stuff and bring up those two kind of common problems with quants being frustrated by bureaucracy because they can't touch production, or ending up with this kind of proliferation, like you said, of these isolated tech stacks built by people who aren't focused on enterprise technology stuff. And they 100% of the time, they always nod and then tell me stories about how that's played out with them. And that's the problem for them, that they've got these like teams of really smart commercial people, but they just can't figure out how to untie their hands and get them, being super productive.
Well, I would imagine too, RegTech or regulation technology comes into play with your platform. That's got to be kind of an overlay that these guys need as well.
Yeah, absolutely. And I think there's kind of two angles to that. Like the first one is, using Beacon to run some of those complicated firm-wide risk calculations that come out of the regulatory changes. And those are, computationally expensive, really hard to get right, fundamentally cross-asset. And, we definitely, help our clients solve those problems. I also think, another thing that's come out of regulatory change has to do with, and this is like a little bit of inside baseball, but really, I think really important is technology controls. So that means like the steps you have to go through if you've like built something in a development environment, the steps you have to go through before you're allowed to, make those changes in the production software. And those are like really complicated, and there's tons of rules about it. And if you're not careful, it's really easy to like kind of go overboard and be ultra conservative about it. And this ends up slowing down your development process so much that innovation gets choked out. That's, I think, one of the things that we figured out how to do when we were at banks, working in these, highly regulated environments, is figuring out how to kind of include that workflow of deploying stuff to production, because our product has a production environment as well as a development and research environment, so it's kind of the whole stack. We spent a lot of time figuring out like how do you automate that stuff as much as possible, so that your kind of core production code stays safe, well tested, moves relatively slowly, but still lets you build brand new stuff that's new stuff that's not kind of core production stuff yet. Unless you build that stuff more nimbly and iteratively, which is really important for working with trading desks. And so that's something that we also build into our platform, and that's a key thing that we help our clients solve.
Oh, cool. All right. Well, one last question before I let you go. And I always ask this at the end of these shows, but what are you going to be focusing on for the next 6 to 12 months as you look out into the future? And I know things are changing rapidly, so that may even change from what you say, but I find it fascinating because this world is evolving so quickly. I think to think ahead is really helpful for our audience.
Yeah, I mean, we recently closed a strategic investment round led by PIMCO. So now we've got like a nice pool of capital to grow the company. I think there's kind of three main areas that we're focused on. The first one is modeling fixed income products like corporate bonds, mortgage-backed securities, and that kind of stuff. That has a lot of relevance for fixed income asset managers like PIMCO, as well as insurance companies, which I think insurance, there's a lot of neat stuff happening there, especially in life insurance. Second thing for us is the commodity space. So we've done a lot of work over the last couple of years building out commodities trading and risk management applications, particularly so far mostly kind of for financial commodities markets. And we're doing a big push into the physical commodity space because we think there's a lot of opportunity to kind of upgrade the suite of vendor technologies that are in use. And then the last thing we're doing is working with U.S. regional banks like retail and commercial banks. They've done a lot of work post-crisis, especially in building out their suite of models that they basically had to do to satisfy regulations. And now that they kind of got over that hump, we're building products to help them take all that stuff they did and like use it to help them run their business more efficiently. So those are kind of like the three product areas we're building out, and they're all built on top of this core platform product that we're continuing to invest in to make that even better too.
Okay, Chief Operating Officer and co-founder of Beacon Platform, Inc., Mark Higgins, thanks for coming on the show today.
Thanks very much for having me. This is great.
It's been a pleasure. That's our show for today. Remember, you can get access to all the shows we do here by either going to our website at cftc.gov or by getting out your phone, clicking on the podcast app, and typing in CFTC Talks. Click subscribe if you want to get them every week. I'm Andy Bush, Chief Market Intelligence Officer for the CFTC. Thanks for listening. This has been CFTC Talks.
But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.